1 minute ago, gold collapse, down $3.4 trillion as silver sinks 12% from new record highs. Just minutes ago, the world's oldest safe haven did something no one was prepared for. Gold, after touching historic highs, erased nearly $500 an ounce in a matter of hours, wiping out $3.4 trillion of global value. Silver, fresh from one of the strongest rallies in modern history, suddenly cracked, falling nearly 12% as markets froze. This didn't happen in isolation. Tech stocks fell, liquidity vanished, and volatility began feeding on itself. The question isn't what fell, but why everything fell together. And more importantly, what this sudden collapse is quietly warning us about what comes next. The shock event, what just happened in the markets. Only minutes before global markets opened, the numbers told a story that few were prepared to face. Gold, long trusted as the ultimate safe haven, reversed sharply from fresh record highs. In a single violent move, its price dropped by nearly $500 per ounce, falling toward the 5,100 level. For a market measured not just in ounces, but in centuries of trust, the scale of the move was extraordinary. By conservative estimates, this sudden fall erased around $3.4 trillion from the total value of gold believed to exist above ground. Silver followed with even greater force. After reaching levels not seen in modern history, the metal plunged close to 12%. This was not a slow decline or a gradual correction. It was abrupt, fast, and disorderly. Only days earlier, silver had posted one of its strongest monthly advances on record. Now, within hours, much of that confidence vanished. Observers initially searched for a single trigger. There was no major central bank announcement, no formal policy shock, no geopolitical event large enough to explain such synchronized moves. Instead, the explanation appeared in the background, spreading quietly across markets before becoming impossible to ignore. At the same time, precious metals were collapsing. Major U.S. technology stocks were also under heavy pressure. Shares of leading firms tied to artificial intelligence and cloud computing dropped sharply at the opening bell. Earnings reports revealed slower growth in key business segments that had been priced for near perfection. Investors who had crowded into the same trades began to exit together. This mattered because the modern financial system is deeply interconnected. Large funds do not hold gold, silver, and technology stocks in isolation. They hold them as parts of the same portfolio. When one area experiences stress, capital is often pulled from others to manage risk, meet margin requirements, or reduce exposure. In this environment, even assets considered safe can be sold aggressively. Gold's decline challenged a widely held assumption. For decades, many investors believed gold would rise when uncertainty increased. Yet this event showed that in periods of extreme volatility, liquidity can matter more than narrative. When price swings grow large and fast, the priority shifts from protection to survival. Assets that can be sold quickly are sold first. Silver's behavior reinforced this message. Unlike gold, silver is both a monetary and an industrial metal. Demand from technology, energy infrastructure, and manufacturing has been a major driver of its recent rise. But this dual role also makes silver more sensitive to shifts in economic expectations. When fears grow that growth may slow, silver can fall harder and faster. What made this episode stand out was timing. Both metals had just reached record levels. Momentum traders were active, leverage had increased, confidence was high. In such conditions, markets can become fragile. A small change in expectations can trigger a much larger reaction once positions begin to unwind. As prices dropped, volatility increased. Each sharp move forced more selling, not because investors had changed their long-term view, but because they were reacting to price action itself. This is how volatility feeds on itself. Falling prices reduce liquidity. Reduced liquidity increases price swings. Larger swings force more selling. The cycle repeats. Analysts watching the market noted that trading conditions deteriorated quickly. Bid-ask spreads widened. Depth disappeared. Market makers became more cautious. In plain terms, it became harder to trade without moving prices further. This is not unusual during stress, but it is dangerous when it happens at record price levels. The size of the gold market amplified the impact. Gold is held by central banks, institutions, funds, and individuals across the world. A near 9% drop from the highs may not sound dramatic in equity terms, but for gold, it is severe. When measured against the total value of all gold, the losses become staggering. Silver's fall was more visible in percentage terms, but gold's was more significant in absolute value. Together, they sent a clear signal. This was not a minor correction. It was a broad repricing event. Importantly, this did not mean the long-term case for precious metals had disappeared. What changed was the short-term balance between buyers and sellers. Markets that rise too far, too fast, can become unstable. When confidence breaks, even briefly, the reversal can be violent. By the end of the session, both metals attempted to stabilize. Prices bounced from their lows. Some investors stepped in, viewing the move as excessive. But the damage had already been done. Trust had been shaken, assumptions had been tested. For serious observers, the key question was no longer how much gold or silver had fallen. The real question was why markets that were supposed to behave differently moved together. That question pointed toward deeper issues beneath the surface. This was not just a story about metals. It was a story about liquidity, leverage, and how modern markets respond under stress. And it was only the beginning of what needed to be understood. After the initial shock faded, attention shifted away from headlines and toward the inner workings of the market. Prices had fallen, but prices alone did not explain what had happened. To understand the speed and violence of the move, observers had to look deeper into how modern markets function when stress appears. At the center of the episode was liquidity. Liquidity is the ability to buy or sell without causing large price changes. In calm conditions, liquidity is taken for granted. Orders are matched smoothly. Prices move in small steps. But when volatility rises, liquidity can disappear much faster than most expect. As gold and silver reached record highs, trading activity increased sharply. Many participants entered the market at the same time, often using leverage. Leverage magnifies gains, but it also magnifies losses. When prices began to turn lower, those leveraged positions quickly became vulnerable. The first wave of selling was not driven by panic, it was mechanical. Stop-loss orders were triggered, risk limits were breached. Funds reduced exposure to stay within internal rules. These actions were automatic, not emotional, but their effect was powerful. As selling increased, market makers faced a difficult choice. They are expected to provide liquidity, but they also manage risk. When price swings grow too large, quoting tight prices becomes dangerous. A small mistake can lead to large losses. In such moments, they widen spreads or step back entirely. This is when the structure of the market becomes visible. Gold and silver are traded through futures, spot markets, and exchange-traded funds. These markets are linked, but they are not identical. Stress in one area can quickly spill into others. In this episode, futures markets felt the pressure first. Rapid price moves forced traders to post more collateral. Some were unable or unwilling to do so. Positions were closed. That added to selling pressure. At the same time, activity in metal-backed funds increased as investors moved capital in and out. What mattered most was timing. The selling happened during a period of heightened uncertainty in other asset classes. Technology stocks were falling. Volatility measures were rising. In such an environment, liquidity providers become cautious across all markets, not just one. As liquidity thinned, each trade had a larger impact. Prices began to gap lower rather than move smoothly. This made risk even harder to manage. More participants stepped back. The market entered a feedback loop. This loop is well known but often misunderstood. Falling prices cause liquidity to shrink. Shrinking liquidity causes larger price moves. Larger moves force more selling. The process feeds on itself until an external force interrupts it, either through time, new buyers, or reduced selling pressure. Silver was especially vulnerable to this dynamic. Its market is smaller than gold's, and its price had risen faster in recent weeks. That combination made it more sensitive to forced selling. When liquidity vanished, silver fell sharply. Gold behaved differently, but not independently. Its market is deeper, but its role as a source of liquidity worked against it. In times of stress, gold is often sold not because it is unwanted, but because it can be sold. Investors use it to raise cash quickly. This explains why gold did not act as a hedge in the moment. The problem was not confidence in gold's long-term value. The problem was the short-term need for liquidity. In such moments, even the most trusted assets are treated as tools, not refugees. Another factor was concentration. Many portfolios had similar exposures. Gold, silver, and technology had all performed strongly. When one area came under pressure, diversification failed. Assets that were supposed to balance each other moved in the same direction. This is a critical lesson for decision makers. Markets are not just driven by fundamentals. They are driven by structure, positioning, and rules. So when too many participants are positioned the same way, the exit becomes crowded. As the session progressed, volumes told a clear story. Trading surged in some instruments and fell in others. This uneven behavior signaled stress rather than confidence. It showed that activity was driven by necessity, not conviction. By the time prices attempted to stabilize, the damage was already visible. Liquidity had not fully returned. Volatility remained elevated. Participants were cautious. The system had absorbed a shock, but it had not yet recovered. For those watching closely, this raised a more serious concern. If liquidity could disappear so quickly at record prices, what would happen under more severe conditions? This question lingered as markets moved forward. The sell-off was no longer just about gold or silver. It had become a warning about how fragile modern markets can be when liquidity is tested. And this warning would shape how the next moves were interpreted. As the immediate mechanics of the sell-off became clearer, a more unsettling pattern emerged. Assets that were expected to behave differently began to move in the same direction. Gold, silver, and high-growth technology stocks all fell within the same window. This was not coincidence, it was contagion. In recent years, markets had been shaped by a shared assumption. Technology, artificial intelligence, and innovation-driven growth would continue without interruption. At the same time, precious metals were expected to benefit from uncertainty, inflation risks, and long-term structural demand. Many portfolios were built on the belief that these themes could coexist and even balance each other. That belief was tested in this episode. The decline in major technology companies did more than erase equity value. It forced a reassessment of expectations. Earnings results showed that growth in key areas was slowing, not collapsing, but slowing enough to challenge high valuations. For investors positioned for perfection, even small disappointments mattered. When these stocks began to fall, the reaction spread beyond equities. Large institutions manage risk at the portfolio level. Losses in one area increase pressure elsewhere. Capital must be rebalanced. Exposure must be reduced. This process does not discriminate between asset classes. Silver felt this pressure first. Unlike gold, silver is tightly linked to industrial demand. It is used in electronics, data infrastructure, and energy systems. When concerns grow about the pace of technological expansion, silver's outlook becomes more uncertain in the short term. The market reacts quickly to that uncertainty. Gold, despite its reputation, was not immune. In periods of calm, gold is held for protection. In periods of stress, it becomes a source of liquidity. Funds sell what they can sell, not always what they want to sell. Gold's depth and global acceptance make it easy to convert into cash. This behavior revealed an uncomfortable truth. Correlations are not fixed. They change under pressure. Assets that appear unconnected during stable times can become tightly linked during stress. Diversification works best when markets are orderly. When disorder appears, correlations often rise toward one. Another element was positioning. Both metals had experienced strong gains leading into the event, and momentum strategies had increased exposure. When momentum broke, those same strategies reversed. The shift was sudden and amplified by automated systems reacting to price levels rather than fundamentals. The technology sector contributed in another way. Many funds that held metals also held technology stocks. These positions were part of a broader growth and innovation theme. When that theme came under question, it was reduced across the board. This explains why selling occurred even without new information specific to metals. The trigger came from outside, but the impact was internal. Markets transmitted stress through shared ownership, shared leverage, and shared expectations. Observers also noted the psychological dimension. Record highs create confidence. Confidence encourages risk. When prices reverse sharply from those levels, confidence breaks quickly. Investors who entered late rush to exit. This accelerates, moves, and deepens losses. The rapid fall in silver in particular reflected this dynamic. After an extraordinary rise, expectations had become extreme. When prices turned, there was little support until much lower levels. The drop was not a verdict on silver's future role, but on how crowded the trade had become. Gold's decline was slower but heavier in impact. The absolute value lost was enormous. This shook sentiment, especially among those who viewed gold as a stabilizing force. The realization that gold could fall alongside risk assets forced a reconsideration of assumptions. Importantly, none of this required a systemic failure. It did not require defaults, policy changes, or crisis headlines. It required only a shift in expectations and a tightening of liquidity. That was enough. As the day progressed, markets attempted to find balance. Some buyers returned, seeing opportunity in the decline. But the sense of certainty was gone. Investors had been reminded that markets can change character quickly. For decision makers, this episode highlighted a key risk. Modern markets are tightly connected. Shocks do not stay contained. They travel through portfolios, strategies, and balance sheets. The lesson was clear. When one dominant theme weakens, its effects can spread far beyond its original boundaries. Precious metals were not isolated from the world of technology and growth. They were part of the same system. This understanding set the stage for the final question. If correlations rise during stress and liquidity becomes fragile at record prices, how should serious participants think about risk going forward? That question would define the next phase of analysis. By the time markets attempted to stabilize, the price damage was already visible. But for serious observers, the most important signal was not the size of the losses. It was the behavior of the system itself. Gold and silver had not failed because their long-term role disappeared. They failed because the structure around them became unstable under pressure. This distinction matters. Markets do not break first at the level of fundamentals. They break at the level of liquidity, positioning, and risk management. What unfolded was a reminder that modern financial markets are engineered systems. When stress enters, outcomes are shaped less by belief and more by mechanics. One of the clearest lessons was the difference between long-term value and short-term price behavior. Gold and silver can remain strategically important while still experiencing violent drawdowns. Decision makers who confuse these time frames often react incorrectly. They either panic at the wrong moment or become complacent during rebounds. Another warning came from speed. The collapse happened quickly, with little warning. Prices move faster than most models anticipate. This exposed a weakness in how risk is often measured. Many systems assume normal conditions. They struggle when markets shift abruptly from calm to disorder. Liquidity risk stood out as the central issue. In theory, large markets should always be liquid. In practice, liquidity is conditional. It exists only when participants are willing to provide it. When volatility rises, that willingness fades. This can happen even at record price levels. For executives, investors, and portfolio managers, this has practical implications. Assets that are considered safe may not protect capital during short-term stress events. They may instead become sources of liquidity for others. Planning must account for this reality. Diversification also requires reassessment. Holding different assets does not guarantee protection if those assets are owned by the same participants and funded in similar ways. True diversification is about behavior under stress, not labels under calm conditions. This episode also highlighted the danger of crowded trades. When too many participants share the same view, the exit becomes narrow. The more successful a trade becomes, the more fragile it often is. Record highs can hide underlying risk. Another important signal was the interaction between technology markets and commodities. Silver's industrial role tied it closely to expectations about growth, innovation, and energy. When those expectations weakened, silver reacted immediately. This linkage is structural and likely to remain. Gold's behavior was more subtle but equally important. Its decline did not signal a loss of trust. It signaled a temporary shift in priorities. In moments of stress, liquidity outranks protection. Understanding this helps avoid false conclusions. The response after the crash also mattered. Prices attempted to recover. Buyers appeared, but volatility remained elevated. This suggested that confidence had not fully returned. Markets were searching for a new equilibrium, not resuming the old one. For serious decision makers, the correct response is not prediction, but preparation. This means stress testing assumptions, reviewing liquidity access, and understanding how portfolios behave when correlations change. It means asking uncomfortable questions before markets force answers. The event also served as a reminder about leverage. Leverage accelerates outcomes. It magnifies gains during rises and losses during reversals. Systems built on leverage are inherently unstable when conditions change. Reducing reliance on leverage can reduce vulnerability. Importantly, this was not a signal to abandon precious metals or technology altogether. It was a signal to respect market structure. Long-term themes can coexist with short-term instability. Ignoring either leads to poor decisions. The deeper warning was about complacency. Record highs often create a sense of safety. They suggest strength and validation. But they can also mark periods when risk is highest. When prices move far ahead of liquidity, even small shocks can cause large reactions. As markets move forward, participants will watch closely for signs of normalization. They will look for stable volume, tighter spreads, and calmer price action. Until those appear consistently, caution remains warranted. This episode did not mark an end. It marked a transition. It revealed how quickly conditions can change and how interconnected markets have become. Those who understand this will adapt. Those who ignore it may be surprised again. In that sense, the collapse was not just a market event. It was a strategic warning.